Hey everyone, Merry Christmas and welcome to my channel. Today I'm going to be doing a market update and recap for Phoenix, Arizona, December 2023. If it's your first time tuning into my channel, my name is Paul Grzenia. I'm a local realtor here in Phoenix, Arizona. And if you're moving or have questions about the market, give me a call. So I'm going to share my screen with you guys today and show you what I look at in the MLS, and then also show you some stats, data, and numbers to hopefully help give you a better idea of what's actually going on in the market. I just think it's important to really look at the data because the numbers don't lie. Also, I think it's helpful to get a couple different perspectives. You know, if you watch some videos, read some articles, newspaper, whatever, everyone has a different opinion. Depending on who you ask, the market could be crashing or the market could be doing very well. I'm going to share my screen with you guys so you can see firsthand what I'm looking at, and hopefully it brings you a little bit of comfort so you know that the market here is still doing good, still doing okay. You know, the market's not crashing here. I don't think it's really crashing anywhere in particular. It's definitely been affected by interest rates, and it's a market. It goes up and down. So enough talking. Let's take a look at this. So you'll see right here, active coming soon listings, just under 16,000 listings. If you're not familiar with coming soon, it's basically a tool in MLS that allows us to pre-market the listing for up to 30 days as exactly what it says, coming soon. We'll do this with listings if you know, we want to get it out there for our pre-marketing, and we may just put a picture of the front, and then that way, you know, everyone knows this house is coming, but still gives us some time to do you know, photos, staging, time for the sellers to move out, whatever the scenario might be. But that's what coming soon means. So now what we can do is we'll take a look at everything that's currently under contract, and you can see we are at just under 6,000 homes under contract. Depending on your market, this might be a lot, this might be a little. You know, you have to remember, regardless of what's going on in the market, there are a lot of people that have to move. They have to buy, they have to sell. Maybe they are relocating for work. Maybe they had a death in the family. Maybe they're going through divorce. So just keep that in mind. Whenever you hear things about what's happening in the market, there are always people that do have to buy and do have to sell. I'm going to pull up the Armless stats. And so this was just published today. And if you see, we're going to look at last month's data. So basically, in January, we can look at December's numbers. You always go back 1 month because the month has to close out. Everything has to be registered and accounted for. If we look at monthly sales, they are down 10.2% month over month, and year over year, they're down 5.1%. So remember that the season is March to June. And if you look at last year and kind of follow, we're on a very similar trajectory, but you can kind of see, you know, December, January is always slow because it's a holiday. Usually this very, very serious buyers are out, or anyone that just doesn't want to deal with competition will be out in November, December, and January. And then you can kind of see as we move into season, we hit that peak. And then June is when summer starts, but July personally is when I think summer starts. It's the hottest month. July, August, September is when summer really is out here. I think June's not bad. And then October is still warm, but you can kind of see the dip in July, level out, and then kind of taper down. And then it basically does the same thing. So new inventory. New inventory is month over month decrease of 15%, while year over year increase by 10.3%. So last year, 5,900, this year, 6,500. And this year's been a little bit more consistent than last year. You can see January, February, March kind of looks like just over 12,000 in that end of May, June, right? And so if we look at total inventory, has a month over month decrease of 0.2%, while year over year reflects a decrease of 14.9%. So we see 17,000, last year was 21,000. And, I think this is very reflective of what was going on with the interest rates. Inventory going up, 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 and then kind of level off. So I think this was, as rates kept going up, people were like, oh shit, let's get the house on the market before rates get too high. And then, so if you follow this from last year, November, going up, 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 and then if you get back over here, I'd say inventory's gone down, but not a huge amount, 14%. Now let's take a look at active under contract CCBS, okay? So here they're talking about active versus under contract listings. So November UCB listings percent of total inventory was 10.3%, with November CCBS listings at 1.7% of total inventory. Now, if we look at month supply, for October was 3.57%, with November at 3.97%. And if we look at this last year, I don't think it's been too crazy. I mean, it looks like it got down to 2% and then kind of came back up. If you're not familiar with months of supply, what that means is if we stayed at the current rate of selling homes and no more new supply came to market, in 4 months, we would run out of supply. When the market was crazy, we were barely at a month of supply. As the market kind of levels out and balances out, we're getting close to 4 months of supply. Now, keep one thing in mind. If you want to call it maybe a sub-market or a micro market, this is for all of Phoenix Metro. If you're looking at, say, Gilbert, Paradise Valley, Scottsdale, those are all going to have different months of supply, because every micro market, town, city, within Phoenix Metro is going to be affected differently. So just keep that in mind. Some areas might be less, some areas might be more. So new list prices. Average new list prices are up 13.2% year over year, and the median list price were up 2.5%. Kind of hard to say the market's crashing if prices are going up, and that might be part of the correction. You can kind of see this through the year. It's up, it's down, it's up, it's down, it's up, it's down, and that's going to be based on who's buying, who's selling, months of inventory, all those things. So keep that in mind. You can see sales price. The average sales price is up 7.4%. The year over year median sales price is up 4.7%. Okay. Now this is the forecast. An increase is forecasted in December for average sales price, while a decrease is forecast in December for median sale price. We're going to take a look at distressed properties. So foreclosures pending month over month showed an increase of 4%, while year over year 0.1%. So we haven't seen a ton of movement there. Not a whole lot going on with distressed sales. So if we look right here at distressed sales, they accounted for 0.2% of total sales, down from the previous month of 0.3%. And there were 2 more short sales compared to 0 last year. Lender-owned sales had a minus 20% decrease year over year. So there's not a lot of distressed and foreclosure properties going on. Just remember, since COVID, the banks have become accustomed to working with their clients to put a plan in place to help keep the clients in their home. So if they're 90 days delinquent, what a lot of the banks were doing, well, okay, we'll take those 3 months, we'll tack it on the back end, and we expect another payment at the end of those 90 days. They are really doing whatever they can do to, in most scenarios, help people stay in their homes. Average days on market, 58, and days on market were down 3 days year over year, while month over month up 1 day. So if you look at last year, days on market was lower You could see down here, maybe that was about 25, 30 days. And then it kind of went up, looks like 61. And then that continues up to 80 and then back down to 58. Also remember, this is for Phoenix Metro, not any particular. So this might be lower or higher depending on the market, okay, or depending on the specific area or micro market. There's some interesting stats in here. For the 21 years Armless has been reporting sales data, the 4,500 sales were the third lowest total ever for November, okay? Armless reported 4,500 sales in November. Only 2007 and 2008 reported fewer sales. Total inventory of homes for sale is down 14.9% year over year. Both demand and supply are extremely low. And they're saying our current market is best described as balanced on a scale of 100. The current Cromford Market Index stands at 104.2. So I guess back in 2021, when everyone was reporting on Douglas Ranch, that's Jerry Coangelo's City of the Future, upon completion, the master plan community is expected to have at least 100,000 residential units that can house 300,000 people. So this is a 37,000 acre Douglas Ranch development purchased in 2002. And let's see, it looks like the first building permit for Douglas Ranch was recently filed. And they're saying the official grand opening of model homes and amenities will occur in 2025. So it'll be interesting to see if they stay on track, because you're talking 100,000 homes. Institutional investors may control 40% of U.S. single-family rental homes by 2030, according to MetLife Investment Management, and a group of Washington, D.C. lawmakers say Wall Street needs to back away from the market. And then let's see what this says. What we're saying is don't have private equity buying up single-family homes. But then Fox says real estate investor warns U.S. is entering the greatest correction of its lifetime, and real estate correction will be at epic levels. I think Grant Cardone, it's going to be a great opportunity for individuals, regular, everyday people to actually grab trophy real estate from institution. This has never happened in the country. Then it says the Federal Reserve plans to tame the housing frenzy with higher interest rates, has a major blind spot. More than 40% of all U.S. mortgages, most of which are fixed rate, were obtained in 2020 or 2021 when rates were at rock bottom. Right here, nearly 2/3 of U.S. mortgages have rates below 4%. If you're looking at a 30-year fixed rate, assuming 10% down payment, the difference between financing an average home with a 30-year mortgage at 7.79% versus 3.6% is $1,223 a month. So that's quite a big hike. It really has an effect on your buying power. Key takeaways: more than 40% of all mortgages were obtained in 2020 or 2021. That's a pretty crazy stat. And it says 64.5% of U.S. homeowners are locked in with mortgages below 4%. So they're not, most of those people aren't doing anything. So here we are again. Nearly 2/3 of existing mortgages have 30-year rates below 4%. And here's the breakdown. 38.2% of mortgages have interest rates between 3 and 4%. 25% have rates between 2 and 3%. And 0.5% have rates below 2%. Surprisingly, only 2.4% of existing mortgages have rates at 7% or higher. Whatever the scenario may be, I just hope this brings some value and kind of gives you a better idea, because it's all noise until you put some numbers and data behind it. It's really hard to make predictions more than 2 months out, I would say. If you're moving or have questions about this video or questions about the market, you can call, text, or email anytime. I'm available 24/7. I appreciate you watching this video. I look forward to seeing you on the next one.